The assumption no one questioned. It was never written down, never formally approved, and never debated in meetings. Yet it shaped every decision as if it were an unbreakable rule of the market itself. The assumption lived quietly beneath models, strategies, and forecasts, accepted not because it was proven, but because it had never failed. To understand why unquestioned assumptions remain one of investing's greatest vulnerabilities today, we need to examine how they form, not suddenly and not deliberately, but through repetition, success, and the comfort of familiarity. Because assumptions rarely announce themselves as beliefs. They present themselves as facts. This particular assumption felt reasonable. Markets would remain functional. Liquidity would appear when needed. Correlations would behave within known ranges. Extreme outcomes would stay rare. It wasn't optimism. It was normalization. Years of stable growth reinforced it. Policy responses smoothed disruptions. Every shock was followed by recovery. Every drawdown felt temporary. Over time, contingency became expectation. Emergency tools became baseline support. What once required justification became automatic. Investment frameworks absorbed this quietly. Risk models embedded it implicitly. Scenarios were designed around it. Limits were calibrated to it. No one asked whether the assumption was permanent, because permanence felt earned. Portfolios were built with precision. Leverage was sized carefully. Hedges were optimized for efficiency. Everything appeared balanced. What made the assumption powerful was not blind faith. It was confirmation. History seemed to validate it repeatedly. Each calm year made questioning it feel unnecessary. The market environment rewarded alignment with this belief. Those who trusted it outperformed. Those who doubted it lagged. Skepticism carried opportunity cost. Gradually, the assumption became invisible. It stopped feeling like a choice. It became the starting point. When stress appeared, responses were shaped around it. Adjustments were incremental. Exposure was managed, not reimagined. The foundation remained untouched. What few noticed was how much depended on that foundation holding. Liquidity, timing, flexibility, all rested on the same quiet premise. The assumption was not reckless. It was logical. It was efficient. It was shared. And that is what made it dangerous. Because when an assumption goes unchallenged long enough, it stops being tested by reality. And when reality finally pushes back, the surprise is not that the assumption failed, but that it was ever treated as certain. The reveal begins here, not with a shock, but with the slow realization that something essential has been taken for granted. The first tension did not arrive as a crisis, but as a subtle mismatch between expectation and outcome that felt too small to justify alarm. Markets still functioned, trade still cleared, and prices still moved, yet something underneath no longer responded the way it always had before. Liquidity appeared, but with hesitation. Correlations shifted, but did not revert. Volatility surfaced, then lingered longer than models anticipated. These were not red flags. They were gray areas. And gray areas are where assumptions survive the longest. Decision makers interpreted the changes through familiar lenses. Temporary disruption, policy lag, external noise, anything except structural change. The assumption remained intact because nothing had clearly disproved it. Stress scenarios were revisited, but their conclusions barely changed. Buffers were adjusted slightly, not rebuilt. The framework held, but pressure has a way of exposing dependency. Small stresses revealed how much positioning relied on smooth exits. Minor dislocations showed how tightly timing mattered. Flexibility began to feel conditional rather than inherent. As conditions tightened, reactions became synchronized. Participants responded the same way, at the same thresholds, using the same logic. The assumption was no longer individual. It was collective. That collectivity changed the market's behavior. Moves that once dispersed now concentrated. Adjustments that once stabilized now amplified. Risk stopped diffusing and started aligning. What made this phase dangerous was how reasonable it felt. No one panicked. No one abandoned discipline. Everyone followed process. But the process itself was built on the same premise. That normal conditions would return quickly. That stability was the default state. Each day that passed without resolution increased reliance on the assumption. Every position held reaffirmed it. Every delay reinforced it. This is how early conflict forms in markets, not through shock, but through persistence. The assumption did not break. It was stressed. And stress, unlike collapse, does not demand immediate action. Yet beneath the surface, the cost of being wrong was rising. Quietly, exponentially, the system was still functioning, but it was functioning on borrowed certainty. And borrowed certainty always comes due. As pressure accumulated, the cost of maintaining the assumption began to surface in places that were impossible to ignore, even for those most committed to the existing framework. What had once been a background belief now demanded constant reinforcement. Adjustments became more frequent. Interventions grew larger. Explanations multiplied, each one intended to preserve continuity. But continuity required effort now. Stability was no longer organic. It had to be defended. Markets reacted faster than assumptions could adapt. Price movements grew sharper. Liquidity withdrew sooner. Correlations held longer. The system was no longer absorbing stress. It was storing it. Every attempt to smooth volatility postponed resolution. Every delay increased dependence. Every reassurance raised the stakes. Participants found themselves managing the assumption rather than the portfolio. Decisions were framed around preserving belief, not around confronting change. This is where full conflict emerges, not between risk and return, but between reality and expectation. Signals were no longer ambiguous. They were inconvenient. They challenged the foundation. And challenging the foundation felt destabilizing. So responses remained incremental. Exposure was trimmed, not transformed. Structures were adjusted, not redesigned. But markets do not negotiate with assumptions. They test them. As stress intensified, the assumption began to distort behavior. Participants held positions longer than intended. Exits were delayed. Flexibility vanished at the margins. The same belief that once enabled growth now constrained response. Confidence turned into commitment. Commitment turned into vulnerability. What made this phase especially dangerous was coordination. Everyone waited for confirmation. Everyone looked for someone else to move first. No one wanted to be early. That hesitation synchronized risk. When action finally came, it arrived all at once. The build-up reached its peak here. In the moment, it became clear that the assumption was no longer passive. It was active risk. And once an assumption becomes risk, it can no longer remain unquestioned. The climax arrived when the assumption finally collapsed under its own weight. Not because markets fail mechanically, but because belief could no longer carry the structure built on top of it. What broke was not liquidity, not pricing, not even confidence, but the illusion that continuity was guaranteed. Once the assumption was exposed, reactions accelerated. Positions were unwound more quickly than intended. Hedges were activated too late to soften impact. Strategies that depended on smooth adjustment encountered resistance everywhere at once. The realization spread unevenly. Some adapted early, accepting smaller losses in exchange for flexibility. Others waited, hoping stability would return long enough to exit cleanly. It didn't. The resolution was not dramatic. It was sobering. Portfolios were restructured with fewer dependencies. Liquidity was treated as conditional, not assumed. Scenarios expanded to include uncomfortable outcomes once dismissed as improbable. The market did not punish the assumption because it was unreasonable. It punished it because it was universal. This story matters because every cycle produces its own unquestioned premise, a belief so widely accepted that it disappears from discussion, a foundation so familiar it feels permanent. But assumptions age, environments shift, and what once felt structural can quietly become fragile. The lesson is not to eliminate assumptions. It is to surface them, to challenge what no longer feels risky because it hasn't been tested recently, to recognize that shared beliefs create shared exposure. Markets rarely collapse from surprise alone. They fracture when surprise meets uniformity. And the most dangerous risks are rarely the ones debated loudly. They are the ones no one thinks to question. So what do you think? Are we repeating the same mistake again? The assumption